Today marks a significant milestone in our current series. We have been journeying through the architecture of a resilient retirement. If you've been with us for the last 2 episodes, you know we've already laid the groundwork. In Part 1, we established the SAFE foundation, understanding the psychology of the descent. In Part 2, we constructed the simple bucket system, organizing your assets to match the timeline of your life. Today, we arrive at the third and final pillar, sound. We are exploring the concept of sound stewardship. This encompasses tax efficiency, required minimum distributions, and the powerful concept of dynamic guardrails. We're covering this today because essentially we have built the engine, but now we must tune it to run efficiently for a 30-year journey. Whether you are 5 years away from retirement or 5 years into it, this episode is designed to give you the specific tactical maneuvers, the how-to, that turns a static plan into a living, breathing strategy. At SafeSimpleSound, our practice has observed a specific tension that arises at this stage. It is the tension between spending now versus sustainability. It's the question that keeps responsible people awake at night. If I spend this money on a trip to Europe today, am I stealing from my 80-year-old self? Many families fly blind here. They either spend too little out of fear, living a smaller life than they earned, or they spend without a governor, risking their future security. Through our S3 approach, we propose a different way. We call it time coexistence. This is the capability to honor your long-term plan while actively adapting to today's reality. It is not magic, it is a system. And today we are going to walk you through exactly how that system works. By the end of this episode, you will understand how to view taxes not just as a bill, but as a lever you can pull. You'll see how government mandates like RMDs can actually become strategic tools. And most importantly, you'll learn about the guardrails approach, a permission structure that tells you exactly when it's safe to spend. Let's step into the sound dimension of your financial life. Let's begin by addressing the landscape we are operating in. When we talk about sound planning in the S3 framework, we are talking about optimization. It is about keeping more of what you have worked so hard to accumulate. The first major component of this is what we call tax-smart sequencing. Now, drawing from our experience in the SafeSimpleSound practice, we often see a very human tendency when people retire. When the paycheck stops, the instinct is to seek safety. And for many, safety looks like spending the cash in the bank first, or selling the investments that generate the smallest tax bill today. It feels safe, it feels simple, but from a sound perspective, it can actually be detrimental to the longevity of your plan. Why? Because your money likely lives in 3 distinct tax environments. Think of these as 3 different silos on your farm. First, you have your taxable silo. These are your brokerage accounts, bank savings, maybe a joint investment account. You've already paid income tax on this money before you invested it, but you pay capital gains taxes on the growth when you sell. Second, you have the tax-deferred silo. This is usually the biggest silo for most families. Your traditional IRAs, your 401ks, you got a tax break when you put the money in, and it has grown tax-free. But, and this is the key, Uncle Sam is a silent partner in this silo. Every dollar you pull out is taxed as ordinary income, just like a paycheck. Third, you have the tax-free silo. This is the Roth IRA or Roth 401k. You paid taxes before the money went in, but now, assuming you follow the rules, it comes out tax-free. Here's the challenge. If you ignore these distinctions and just spend whatever is easiest, you lose control over your lifetime tax bill. For example, if you spend all your taxable cash first because you don't want to pay taxes on your IRA withdrawals yet, you might have several years where your taxable income is very low, perhaps artificially low. You feel great because you're paying 0 taxes. But meanwhile, that tax-deferred IRA is growing in the background. Eventually, you will be forced to take money out of that IRA. If it has grown massive because you haven't touched it, those forced withdrawals might push you into a much higher tax bracket later in life. You save taxes at 12% today, only to pay 22% or 24% later. Our S3 framework suggests an approach. Sequencing. This isn't about avoiding taxes entirely. That's impossible. It's about managing the rate. We want to fill up the lower tax brackets every single year. Imagine a series of buckets representing tax brackets. There's a 10% bucket, a 12% bucket, a 22% bucket, and so on. Each year, we want to fill that 12% bucket all the way to the brim, but not spill over into the 22% bucket. How do we do that? We might take some money from your IRA, just enough to fill the low bracket. If you need more cash for living expenses, we then switch over and pull from the taxable or Roth accounts, which don't drive up your taxable income. This is sound stewardship. It requires coordination. It moves beyond the simple desire to just pay zero tax today and embraces the sound wisdom of paying a lower average tax rate over your entire lifetime. Drawing from our practice's observations, this strategy alone, managing the sequence of withdrawals, can add significant longevity to a portfolio. It allows your money to stretch further, not by taking more investment risk, but by being smarter about the rules of the game. Now, this brings us directly to a government rule that many retirees dread, but which we view as a strategic opportunity. I'm talking about required minimum distributions, or RMDs. Currently, starting at age 73, and that age is climbing based on recent legislation, the government requires you to start taking money out of those pre-tax IRAs. They have waited long enough for their tax revenue, and they want their cut. The traditional reaction to RMDs is annoyance. I don't need this income, a client might say, and I don't want to pay the taxes on it. From a SafeSimpleSound perspective, we reframe this. We don't view RMDs as a nuisance. We view them as a systematic mechanism. Remember our bucket strategy from the last episode? We have bucket 1, which is our now money, cash and short-term bonds for immediate spending. RMDs are the natural engine we use to refill that bucket. Since the government is forcing us to sell a portion of the portfolio anyway, we use that liquidity to replenish your spending cash for the next 12 to 24 months. It turns a compliance requirement into a maintenance routine. But what if you truly don't need the money? What if your pension and Social Security cover your needs and this RMD just creates a tax problem? This aligns with the principle of generosity and efficiency. We can utilize something called a Qualified Charitable Distribution, or QCD. This allows you to send your RMD directly from your IRA to a qualified charity. Here is the beauty of the QCD. The money never hits your bank account, so it never shows up on your tax return as income. You satisfy the government's requirement, you support a cause you care about, and you keep your taxable income lower, which can help lower your Medicare premiums and other costs. This is the essence of S3 thinking. We take a rigid external force, the tax code, and we build a flexible internal system that navigates it with grace. So we have discussed tax sequencing and we've discussed RMDs. These are the mechanics, but the biggest question remains, how much can I actually spend? How do we balance the desire to enjoy the harvest today with the need to ensure the grain lasts through winter? This leads us to the most dynamic part of our sound framework, the guardrails. In our practice at SafeSimpleSound, we often say that a financial plan is not a document, it is a process. It is a movie, not a photograph. The static approach to retirement spending is often called the 4% rule. You take 4% of your portfolio the first year, and then you adjust that dollar amount for inflation every year after, regardless of what the market does. While that is a helpful rule of thumb, it is a bit like setting your car's cruise control at 65 miles per hour and then welding the steering wheel straight. It works fine on a straight, flat road, but if you hit a curve or a hill or traffic, you're in trouble. We utilize a concept known as dynamic guardrails. This concept, often associated with the research of Guyton and Klinger, answers the question, can I afford this raise? Or conversely, do I need to tighten my belt? Imagine you are driving on a highway. You have the yellow line on your left and the white line on your right. As long as you stay in your lane, you keep driving at your target speed. You don't worry about the ditch, you just watch the lines. If you drift too close to the edge, the guardrail, you make a small correction. You don't slam on the brakes, you don't turn the car around, you just nudge the wheel. In our S3 framework, we apply this to your spending. We set specific rules based on your portfolio's performance. There are two primary rules we observe. First, the capital freeze rule. This is for when the markets are rough. Second, the prosperity rule. This is for when the markets are generous. To illustrate this principle in action, let me share a hypothetical scenario. Consider this hypothetical situation featuring a fictional couple we'll call the Millers. The Millers are 68 years old. They have a $1.5 million portfolio, and they follow the S3 framework. Their initial plan allows them to withdraw $60,000 a year from their portfolio to supplement their Social Security. Now, imagine the market goes through a difficult year. A recession hits and stocks drop by 15%. In a traditional static plan, the Millers would be terrified. They would see their balance drop and panic. They might sell everything to stop the bleeding, which is a catastrophic mistake. Or they might continue blindly spending their full amount plus an inflation adjustment, digging a hole they can't climb out of. But the Millers have guardrails. Because their portfolio value dropped below a certain predetermined threshold, their capital freeze guardrail is triggered. Their advisor or their own system says, okay, the markets are down, we are not going to cut your pay, you still get your $60,000. However, we are going to freeze your inflation adjustment this year. Normally, they would have given themselves a raise to match inflation, say bumping their withdrawal to $62,000. But the guardrail says not this year. By simply skipping that small raise, by freezing their spending at the current level, they significantly increase the probability that their money will last. They make a small, manageable sacrifice today to secure their safety for tomorrow. They don't have to panic because the rule has made the decision for them. Now let's flip the script. 2 years later, the markets enter a bull run. The Millers' portfolio grows significantly, well above their initial projections. They hit the other guardrail, the prosperity rule. Their system signals, your portfolio has grown so much that your withdrawal rate has dropped below the safety line. You are actually saving too much money. It is time to give yourself a raise. This is the conversation every retiree dreams of. The system tells the Millers, you can permanently increase your spending by 10%. The Millers now have permission, mathematical permission, to book that extended cruise, or help their grandchild with tuition, or simply upgrade their lifestyle. They aren't guessing. They aren't worrying that they are being reckless. The guardrails have confirmed it is safe. While this story of the Millers is fictional, it demonstrates exactly how our framework functions in the real world. It shows the psychological power of systemization. When you rely on feelings, a market drop feels like a disaster. When you rely on guardrails, a market drop is simply a signal to make a small adjustment. This connects back to our SAFE principle. Safety isn't the absence of volatility. The market will always be volatile. Safety is the presence of a plan that handles volatility. And it connects to simple. You don't need to watch CNBC every day. You don't need to predict interest rates. You just need to check your position relative to the guardrails once a year. Are we in the lane? Yes. Keep driving. Did we touch the line? Yes. Make the adjustment. From a SafeSimpleSound perspective, this provides the stability we look for. It removes the emotional burden of decision-making during high-stress times. It automates your prudence, and it automates your enjoyment. Whether you are facing a scenario exactly like the fictional Millers or your numbers are completely different, the pattern holds true. The most successful retirement plans are not the ones that predict the future. They are the ones that can adapt to any future. As we begin to descend from this deep dive, let's synthesize what we've covered in this Sound Stewardship episode. We have moved beyond the basics of saving and asset allocation. We are now in the realm of distribution mastery. First, we discussed tax-smart sequencing. We learned that where you pull your money from matters just as much as how much you pull. By coordinating your taxable, tax-deferred, and tax-free buckets, you can manage your tax brackets and keep more of your wealth in your pocket over the long haul. Second, we looked at RMDs. We shifted our perspective from viewing them as a government penalty to viewing them as a strategic tool for refilling your cash buckets or fueling your charitable giving through QCDs. And finally, we explored the dynamic guardrails. We saw through the hypothetical example of the Millers how preset rules allow us to freeze spending during bad times and confidently increase spending during good times. This is the S3 promise, peace of mind through systemization. We don't just sell investment products. Products are commodities. We provide a process. By integrating these three elements, tax efficiency, RMD planning, and dynamic guardrails, we transform retirement from a guessing game into a managed descent. You remain the captain of the ship, but you now have a state-of-the-art navigation system guiding you through the fog. This episode draws from our recent blog post titled Sound Stewardship, which you can find at SafeSimpleSound.com. The written post contains visual aids and further details on the Geitenklinger research that we couldn't fully cover in audio format. Through our S3 approach development, we've created a specific resource to help you implement this thinking. It is called the Dynamic Distribution Guardrails Guide. This is a strategy PDF that outlines the specific decision rules we use for capital freezes and prosperity raises. It gives you a professional-grade framework for managing your income. If today's S3 insights resonate with your family's situation, and you find yourself wanting a co-pilot to help set up these guardrails, we invite you to explore what financial planning could look like through our SafeSimpleSound practice. There is also our S3 Mountain Descent Master Map, a single-page synthesis of the entire strategy we've discussed over this 3-part series. But whether you choose to engage with our practice or not, our hope is that you are now equipped with a new capability. You now know that you don't have to choose between spending today and being safe tomorrow. With the right guardrails, you can have both. You can be safe, you can keep it simple, and your plan can be sound. Thank you for listening and for trusting us with your time. Until next episode, keep your eyes on the horizon and stay within the guardrails. Disclaimer: SafeSimpleSound provides educational content and is not a substitute for personalized financial advice. All examples, including the Millers, are hypothetical and for illustrative purposes only. Please consult your tax and financial professionals regarding your specific situation.